The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for Q3 2019. My name is Nick Basso, and I'm a portfolio administrator in Ironwood's Asset Management Division. Tonight, it's my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type those in the chat box on your GoToWebinar panel. I'll compile the questions, and we'll do our best to address all of them at the end of the presentation. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean, please take it away.
Thanks, Nick. Thanks, everybody, for joining tonight's call. As always, seems when we have these calls, we have interesting stuff going on right around the call. Tonight is no different. So we've got lots to talk about. Obviously, we'll talk about tariffs. Late in the day here, President Trump tweeted about more tariffs with China. So we want to kind of go over that and the implications there. We're going to talk about the Fed pivot at the beginning of the year. And within the last 24 hours, well, a little over 24 hours, they did what they called a mid-cycle adjustment. So we'll go over that. We had a budget deal passed today, 2-year budget deal we'll talk about. We'll dive into some of the slow global growth that we see. We'll talk about domestic large cap stocks at near all-time highs and how they may be slightly overpriced. And we'll also talk about earnings season, since this is last week and this week are the largest weeks for earnings. So we'll dive into kind of updated earnings season and go over that as well. All right. Satisfy the attorneys here with the important disclosure information. I thought before we kind of dive into the what I'll call noise, I wanted to kind of take us back a little bit and put this bull market in perspective. A lot of people are worried, that it's been 10 years. The markets have gone up a lot, and they're very fearful. We have 2008 and 2001 in our minds. But what I wanted to do is kind of take a step back and look at least post World War II, the last 75-ish years, and you could see that we tend to have the last two bull markets have lasted about 20 years, followed by about 10 to 12 years of flat, followed by another 20 years, followed by another 10 to 12 years of flat. And thus far, we're from the bottom, we're about 10 years into this bull market. So don't let just the amount of time swayed your thought process on how long this bull market could last. If history is a guide, it could last a lot longer than probably most people think. So I just wanted to start there to give us kind of a perspective of, remember, we're in these markets for the long run, and typically the longer you've given your equities portfolio, your more aggressive asset classes, the better they've performed for you over the long run. So we just wanted to start with that slide there. A lot has changed since the fourth quarter of 2008, so kind of just wanted to paint that picture. In early 2019, the Fed pivoted from their position of basically hawkish position to more of a dovish position, more of a easy monetary policy. We're gonna hold on rates. We're not gonna increase anymore. We did one in December. The market really didn't like it, and so a lot has happened over that period of time. Believe it or not, the 10-year Treasury yield has dropped 75 basis points since the beginning of the year, and we're really close to where we were in November 2016 on yields. It's pretty amazing, considering in October of last year we were at 3.25%. So we definitely, the bond market is really pricing in some kind of slowdown, some kind of possible recession. Which then on the flip side, we have domestic stocks, domestic large cap stocks hitting all-time highs just before yesterday. And even earlier today, before the tweet came out, we were pretty much close to all-time highs if you looked at large cap US. So we've got the stock market telling us one thing, we've got the bond market telling us a different. The yield curve has flattened. It's not as flat as it was in the fourth quarter and early this year, but we're looking at about 15 basis points between the 10-year and the 2-year. The reason that's so important is when if that yield curve, though the 10-year minus the 2-year, if it inverts, very often that means that we have a recession coming down the road. So a lot of economists and the Fed look at that 10 minus 2, and they really don't want that to invert. So we've been, earlier today, we got down to about 12 basis points, but then the market kind of flushed that out, and short rates went lower, and now we're back at about 15 basis points. So that gives us a little buffer, but we definitely want to keep an eye on that. And then what else has happened since the fourth quarter of 2018 is global growth has significantly slowed down. And the stock market basically predicted that in the fourth quarter. The stock market is a leading economic indicator. And with the announcements of tariffs, the stock market, depending on what stock market you're looking at, the S&P 500 in the fourth quarter last year, from peak to trough, was down 19 and some change, almost 20%. And if you looked at, outside the United States, it was even worse than that. If you looked at small cap, it was even worse than that. So the stock markets around the world were predicting this slower growth, which is exactly what we've seen. And we'll go into that a little bit in more detail later on. Here is what the S&P 500 has done thus far in 2019. You can see that in December, really it was December 24th, Christmas Eve, we hit that low point. And ever since then, the market's really been on a pretty good tear upwards. January 4th is when the Fed came out and said they were going to be patient. February 24th, the U.S. paused new China tariffs. And then May 10th, right here, they put those new tariffs back on. And this really was a quick drop of about 7.5%, 8% on the S&P 500. And if you looked outside the United States, and if you looked at small cap, it was a much bigger adjustment. And coupled with what rates had done, it poised a very good opportunity for us, and we rebalanced the portfolio. And as most of you know, we've made adjustments. We got rid of real estate. We got rid of utilities. We lowered our bond exposure. We increased our aggressive assets. We increased our equities. Not so much domestic large cap, but other areas that had taken it on the chin even more than the S&P did during that period. and we started rebalancing right at the beginning of June, and it took us about 2 weeks to rebalance everyone's accounts. But the reasoning behind that is we really, with these new tariffs, we really saw some dislocations in some of the equity markets, especially outside the United States and especially in small cap, where we thought that compared to large cap, there was just a lot more opportunity. And so we increased some of our exposures. And then real estate had significantly outperformed the S&P 500 as rates went down during this last, call it 12 months, from June 2018 to June 2019. Real estate had significantly outperformed the S&P 500, and utilities had significantly outperformed, by 20+% the S&P 500. So in our estimation, those two areas were a little bit overvalued, and we got rid of them, and we wanted to keep that. It's about 5% between those two areas in most of our portfolios, and we moved those to developed international, emerging markets, small cap, and a little bit large cap domestic, just because we had 5% to allocate, and we ended up adding to our large cap bucket a tiny bit, but mostly it went to outside the United States. So then if we were to take this until basically today, we had markets go up. We had the S&P go up to about 3,020. And then today we lost all of the gains that we had earlier this morning, as well as about another percent. So we're back at 29.53, still higher than this chart goes. We're right about somewhere up here. So that's where the S&P 500 has been. Outside the United States, it's a different story. Outside the United States, it's still up for 2019, but much less than here in the U.S. And in 2018, the domestic large cap and small cap definitely outperformed outside the United States. So it just made our case for international even that much stronger, because our valuations look that much more attractive. But one of the reasons that the stock market, in our opinion, went down in the fourth quarter of 2018 is it was predicting some of these slowdowns. This is manufacturing. So for developed economies, for the U.S., manufacturing is not a large part of the total economy, but it's a volatile part. And so on the margin, it makes a big impact when you see some of these slowdown numbers. But you can kind of see that we're rebounding. We're going kind of the opposite way. We're starting to slow down a little bit in some of these areas. And if you look at some of the leading economic indicators, i.e. the stock market, i.e. some of the other information that we have out there, some of these numbers are getting better. But we definitely know that trade is one of the culprits here, and has had a big impact on manufacturing, not only in the United States, but outside the United States as well. So our global manufacturing PMI number is 49.4. That's one of the lower values we've seen in this bull market. So 49.4, which is just a carryover from here, but you can kind of see the services versus the manufacturing. The more important one, at least for developed markets, is the services. And they both come down a little bit, but services is still above 50, whereas manufacturing just went below 50. So this is contraction here. Services are still close to 52, which is we're still expanding. And so there's, these are very important, and services are more important. But you can see we believe the stock market was down 20% domestically in the fourth quarter because the stock market saw this coming with tariffs and trade talk. Well, let's talk about tariffs. So in case you have not heard, President Trump tweeted today and then talked to reporters afterward, and they're adding another 10% tariff to another $300 billion of Chinese goods. A lot of these goods are the ones that were not being tariffed so far, and really consumer. Much more are going to hit the consumer this time. They're set to start September 1st. President Trump also said that depending on how talks go, they've got another meeting set up in September, but he didn't want to wait to use leverage, basically, is what he's doing. Here is a chart of global tariffs, and you can see imposed in 2018, that's this little block here, imposed in 2019, now this is before today, and we've got another block on top of this for today, and then we've got some proposed tariffs. So you can see that the proposed tariffs, if they were all to go into effect, it's a lot higher than any of these other countries. However, on the margin, it's not a lot of dollars compared to GDP of any of these countries. But psychological and how people react and what happens with business, it does make a big difference. And you can see that here in trade. The average trade volume is 5% over the last, call it 30 years, 20 years, 30 years. It's down to 0.3% in May. This is due to this trade rhetoric. And so everyone's just kind of slowing down what they're doing, and they want to know what the outcome's going to be. Now, at some point, they're going to either have to move forward and pay the tariffs or find different avenues for their supply chains. We believe China is going to be very proactive, and they're not going to want to see business going to other places. And we also think that President Trump's going to want some kind of deal because in 15 months, there's this thing called the election that he's going to want to try and win again. So we think that both parties have a big incentive to get a deal done. When that happens, we're not sure. It's good news that they have a meeting in September. Obviously, added tariffs are not the greatest news. If the end outcome is that we end up with less tariffs and more free trade, it will be a positive for the global environment. And we believe that that does happen. And our rebalance back in June reflects our opinion of that happening and reflects some opportunity outside the United States to get some outsized returns if and when that deal happens. If and when that deal happens and the markets go up like we believe they will when that happens, we will be repositioning the portfolio back to a more neutral position at that point in time. One other comment here is the United States does not have a lot of export share. 8% of GDP is due to exports. And that's why President Trump is using these tariffs, because he knows that these other economies are going to be more susceptible, more damaged by this type of activity. He's got leverage, and he is definitely using it. We're not saying we agree with that policy, but if it ends up that we end up with lower tariffs at the end of this, a China deal, they're not taking intellectual property, we have more free global trade, we believe that'll be a boon and a very positive thing for all economies around the globe. The U.S. economy, because of its lesser impact on exports, has been really the bright spot around the globe. But even even with that said, we've got 10-year Treasury rates at 1.9% versus 3.25% 8 months ago, 9 months ago, in the fourth quarter of 2000. I'm sorry, that should say 2018. The 10 minus the 2 we talked about is at 15%. ISM manufacturing for the United States is still above 50. It came down a little bit in April, May, and June, but not much. And then the services is still around 55, 57, 55. So those look good. The job market couldn't be stronger. We get a jobs report tomorrow. So not only do we have a bill get passed, we got new tariffs, we got a rate cut, we've got a jobs report tomorrow. We've got earnings all over the place. This has been a really, really busy week. GDP came out a couple weeks ago. The first quarter finalized numbers 3.1%, and Q2 was upgraded. It was thought that it should be about 1.8%, but it actually came in at 2.1%. A big part of why it came in ahead of expectations is that the U.S. consumer, has been filling in the gap. The U.S. consumer expenditures were up 4.3%, which is the best number one of the best numbers. It's the second best number we've seen in 3 years. So definitely, we've got a slower economy, slower global economy, which is impacting the U.S. a little bit, but the consumer is strong, and the consumer filled that gap nicely, and the consumer's 70% of the U.S. economy. So that is definitely a bright star here, is the U.S. economy. This is just to kind of show the difference between 2018 and 2019. The big difference really is sentiment, and it's these gray bars, which if you look, it's multiples. It's what people are willing to pay for earnings streams. 2018, a lot of uncertainty, a lot of things going on. The market participants didn't want to pay high multiples, and therefore a lot of the asset classes, a lot of the aggressive asset classes did poorly in 2018. On the flip side, 2019, sentiment improved. Things started to become a little more certain. We had some positive things happen. And now you get multiples expanding. And that's the majority of the change in the return on these asset classes in 2019. That is what I'm going to call the noise. That's noise. That people, in a perfect world, you know what you're going to pay a multiple. You know what kind of multiple you're going to pay depending on the type of business it is. So multiples really shouldn't fluctuate all that much in a perfect world. We know they do, obviously. We can see it right here in this chart. However, if we look at a longer period of time, you can see there are two things that drive returns. Two. It's this blue and this light blue. And if we look down here, it's earnings and it's dividends. Those two are what drive your rate of return over longer periods of time. So it's important to look at those and build your portfolio for the long run according to where you believe those are going to be the best. Okay, so this is the S&P 500 over the last 20 years, 30 years. We all have the dot-com bubble in our minds. We all have the financial crisis in our minds. And then, man, this looks pretty dang good. We're up 345% since the market low. PE multiples. Now this is dated. It was 2 days ago. The S&P 500 was at 3,013. We're slightly under that, but these numbers are going to be pretty dang close. Call it 16.8 instead of 17.1. At these levels, 17.1 forward, 2% dividend yield, If you didn't tell me the Treasury was at 1.9 right now, I tell you, we're getting expensive. You tell me that the 10-year Treasury is at 1.9. I'll tell you, well, we're probably still a little expensive looking at the S&P 500. So the S&P 500 is large cap U.S. stocks. I'd still say we're even with a low Treasury, I'd still say we're probably a little bit on the overvalued side of things, because at some point, if the economy does pick up, the Fed is not going to be cutting rates, and rates should, I know we've been saying this for a while, but rates should be higher than 1.9% with this type of an economy. Yes, I know there's some things going on around the globe that artificially are bringing our rates down, but at some point those things are going to clear up, and we're going to have higher interest rates. And at a 17 multiple, if we have higher interest rates, that's a pretty expensive multiple. The other thing that we're kind of concerned with is the composition, the concentration of the S&P 500. So we went ahead and built this little pie chart here. Right now, the top 10 companies in the S&P 500 are Microsoft, Apple, Amazon, Google, or if you want to call them Alphabet, Facebook, Berkshire, JP Morgan, Johnson & Johnson, Exxon, and Visa. And they make up 23% of the total market cap. So even though if you buy the S&P 500, you think you're getting a diversified portfolio, but really you're getting 25% of these 10 companies. If you notice, Microsoft, Apple, Amazon's kind of a strange one, but Google, Facebook, these are all tech-heavy companies. You've got a couple financials in there, an oil stock, you got another financial, and then you've got some consumer goods company. I would argue that Amazon's kind of a tech company. So you're not getting the diversification that you may think you're getting when you buy the S&P 500. And then also, when you see these types of concentrations like this, it's not always the best sign. So at the beginning of 2000, the top 10 S&P 500 companies were 22%. One of those companies was GE. For a couple of years, it was the highest, the biggest market cap stock. It is no longer on that list. It has lost a tremendous amount of market value. Any of these companies could. So when you own the S&P 500, you just need to know what you own, and you need to be careful. It's not as easy as everybody makes it sound, where you say, I buy the S&P 500 and just hold it. Over the last 10 years, yeah, that's been an awesome strategy because large cap has done very well because these 10 companies have done very well. Going out over the next 10 years, I do not believe that you're going to get these types of returns that we've gotten over the past 10 years in the future 10 years. The top 5 of those companies, so Microsoft, Apple, Amazon, Google, and Facebook, currently represent 15.9% of the S&P 500. So that's pretty close to where we were with the .com era. I'm not saying that we're going to have an imminent burst in the bubble. I'm just saying that the S&P 500 seems a little concentrated and a little overvalued, and there are a lot more opportunities for us. We haven't abandoned the S&P 500. It's still the largest holding of almost every single one of our clients, as far as aggressive assets go, at least. But we've definitely reduced our exposure to the S&P 500 because of some of these things. It's just once an area does well, it becomes less attractive. Over the next 10 years, we expect large cap US companies to return somewhere between 5 and 6%. So nowhere near the last 10 years where we're probably at about 12% on the S&P 500. All right, let's move into earnings. So the forward earnings in April were about $173. They've improved to $176. You can see the forward earnings here have just kept, we had a little bit of a dip at the end of 2018, but they've continued to come up. 2020 earnings have been revised downward as we've been going. 2019 has been revised downward as we've been going. But you can see analysts, they tend to always go one way or the other, and then they go too far. They brought Q1 earnings estimates way too low, and then when earnings came out at the end of Q1, they realized they got it wrong, and so they had to revise their estimates because now earnings had come out, and now we know what Q1 earnings are, and they're a lot higher than what they were expecting going into Q1. And Q2 so far looks not as dramatic because they had better earnings, but definitely there's more surprises on the upside than there have been on surprises on the downside if you look at it on a more global level. And then you can see Q3 and Q4, they're still bringing those down, and they'll probably continue to bring those down. At the current PE multiple, I did the math as of today, $176 per share is the forward estimate. The current price after today's tariff announcement, the S&P finished at $29.53. So that gives us a PE of just under 16.8. Normally, that's a little high, but once again, 1.91% 10-year multiple. We could probably argue for 18 to 20 multiple. However, if the U.S. economy and the global economy recover, the Fed is probably not on a rate cut cycle. They're probably going to shift back to rate hikes, which then this will go up, and we can't argue this anymore. So we do want to be careful when we're looking at these. But 16.78 doesn't concern me at the current juncture. I look at other areas, and there's just more opportunity outside the United States. And if we want to stay inside the United States, we believe small cap just looks a lot more attractive. Some more ammo here to say the S&P 500 might be a little overvalued. If we look at different valuation measures, all of them say that we're overvalued except for the earnings yield spread. And that just says that stocks are more attractive than bonds. So that's just telling us that bonds are probably way overvalued. And maybe the S&P 500 is kind of near fair value, but bonds are significantly overvalued. and that's more of a relative metric. But what this doesn't show us is the areas outside the United States that look much more attractive. Sources of earnings per share thus far in 2019, it's been kind of a real simple story. We've had margin contraction that's offset revenue growth of about 2.2%, and we've been buying back shares over the last few years. Last year at a record pace, this year at a pretty good pace, not quite as high as last year, but pretty good. So the total earnings per share for the year is a little over 2%, and almost all of that has come from share buybacks. That is not a sustainable strategy. So we really want to see margins firm up, and we also want to see revenues pick up a little bit. The buyback story is right here. You can see in 2018 we had an enormous amount of buybacks. We had the tax change. A lot of companies had extra cash. They bought back their stocks. So when they buy back shares, there's less shares outstanding. All else being equal, the same earnings get you a higher earnings per share if you have less shares. So that's what I'm talking about when I'm saying the 2.1% total earnings per share gain has come primarily from share buybacks. This is one that we show almost every presentation. It's just telling us, over the short run, PE multiples don't give us a good idea of what stocks are going to do over the short run, but over the longer run, they do. And when we look at over the next 10 years, we're expecting, 5 to 6% from S&P 500 going forward. That's not a horrible return when you look at bond rates at 1.9%, but we see better opportunities when we're looking over 10-year time horizons. Probably the strongest part of our economy, the consumer, the unemployment. The unemployment rate ticked up a little bit in June. We get a new report tomorrow. Based on ADP, it should be pretty good. We didn't see anything in the ADP survey to concern us. Average annual wages were up 3.1% year over year. Unemployment was up unemployment rate was 3.7%. The Atlanta Fed wage tracker, which is one I like to look at, will tell us that wages, if you take the people who have been in work less than a year, if you take them out, you can see that wages have actually gone up 3.9%. According to their wage tracker, which is a very strong number, and it's improved tremendously in the last, call it, 2 years. Productivity at the final number for Q1 came in at 3.4%. That's the big wild card. If we can get productivity to be 3.4%, anywhere close to that, that is going to be able to push us into growth that we're not used to seeing. And so that's definitely one that's picked up as of late. And that's the wild card. That's the number that I'd like to keep seeing over this 3% number. That'll really kind of show, I think, what deregulation and what some of this tax cuts and the pro-business type policies will help promote. The consumer, like I said, continuation of the last slide, is doing fantastic. Personal consumption, which is a piece of GDP, it's the largest piece of GDP, was up 4.3% in Q2. That was the second highest growth rate we've seen from the consumer in 3 years. So these tariffs are not changing the U.S. consumer into spending less money, or at least it's not coming out in the numbers. There's a decent job number. Housing is still affordable. Gasoline prices are still low. Balance sheets look great. Debt looks low. So consumers look very strong. What doesn't look very strong is our federal finances. And today we had an announcement that that Congress passed a bill that's basically gonna get rid of the sequester for a couple of years. It's gonna increase annual spending by about 3.5% annually. It's going to increase the deficit in 2019 to $1 trillion. So you can see here, it's just over 4%. This is an old slide. This is before today. So this number right here is going to go up to about 5% for 2019. And then 2020, discretionary spending alone is going to be $1.37 trillion. So we definitely increased the spending with this bill. They waived the debt ceiling for 2 years, so that won't be an issue during the election process. But to us, it seems like there's not a lot of people that are worried about spending right about now. When we have Medicare and Social Security that are 51% of our total spending each year, we've got to fix these programs. There's a Social Security 2100 bill coming that's going through that kind of got delayed. We'll see what ends up happening there. Hopefully they can figure out Medicare, but some of these things definitely need to be fixed for the long term. And the CBO's forecast at night is probably going to go up to probably 95% after today's passage, maybe even higher. Now, granted, they've got some pretty conservative GDP numbers, so we're going to have to see when this becomes a problem. If the economy's growing, it's not a problem. But when you're spending 5% of GDP every year, it can become a problem if you have any kind of slowdown. So definitely paying attention to the federal finances. Interest rates at 1.9%, really not going to be that big of a deal. Interest rates go up, more of a big deal every time we see interest rates go up. Growth has definitely slowed down a bit due to the trade talk, the global tensions, but just like we've been talking about, the consumer filled that gap nicely with that 4.3% personal spending. Let's move on to international, because I think this is where there's a lot of blood on the street internationally. And when I say that, I mean emerging markets, developed international, they're still positive for 2019. They're just significantly 15, 20, 25% from all-time highs. And their valuation metrics look very attractive. If we look at Europe, yeah, they've slowed down a bit, but their unemployment's going the right direction. Their wage growth's going the right direction. They've got easy monetary policy. We could see some positive things out of Europe. China definitely has had an impact. They're seeing a slowdown. Tariffs are hitting them very, very, very hard, and it's bringing them to the negotiating table. If this ends up with where we have some sort of deal, we believe that emerging markets and China are probably very attractive at these levels. And if we do seek some kind of deal, probably that gives investors the all clear to jump in. Unfortunately, when they're jumping in, they're probably jumping in at prices that are 15, 20% higher from where we are now. Here's kind of just a relative price to book ratio comparing the emerging markets to the S&P 500. And as you can see, we in the fourth quarter last year had a very big underperformance from emerging markets, which has made them much more attractive. They're at 0.49 times the S&P 500, when on average during this entire period, they're closer to 0.7 times. So if they get back to, if people are more likely to purchase emerging markets, they see an all clear, they feel more comfortable with it, they're going to pay higher multiples, and that's going to push this emerging markets relative to the S&P 500 back up to its norms. And as you can see, emerging markets could be a lot higher than that at times as well. So down at 0.49, we believe this is a very attractive place to be. And even if you look at the last 20 years and you look at a portfolio of 100% US stocks, 0% emerging markets, your return would have been 5.9% in that portfolio. So that's the S&P 500 over the last 20 years. Your Sharpe ratio would have been 0.26. Your volatility would have been 14.6. If we add 10% emerging markets, you get 0.3% rate of return higher. And your volatility does not go up very much. So that makes your Sharpe ratio go up. A higher Sharpe ratio is preferred. It means for every unit of risk, this purple bar, we're getting 0.27 return. So you're getting a higher return versus your risk, the higher the Sharpe ratio. So you can see, somewhere in between here is would have been the happy medium over the last 20 years of US versus EM, where you're getting paid for the risk that you're taking. You're getting paid the highest amount, 0.29. So you're getting paid 6.6% from a 70-30 portfolio, taking 15.7% risk or volatility. And that gives you a Sharpe ratio of 0.29, which is exactly what we want. We want a high Sharpe ratio. So unless you're younger and have a long time to invest, 30% EM into a portfolio is quite a bit. Most of our portfolios are somewhere between 10 and 20%. If you're more conservative, we're talking probably more like 5 to 10%. But you can see that that's the concept. We want to add a very risky piece that's at very attractive levels. It doesn't mean that it can't get more attractive. It doesn't mean that there can't be more blood on the street. It just means over the next 10 years, we believe that we're going to have 7 to 8, maybe even 9% per year from emerging markets compared to 5 or 6% from the S&P 500 when we look at the next 10 years. We want to make sure that we participate in some of those higher returns. Developed international, same exact story. I was looking at a chart the other day. I think I'm going off of memory here, so don't put me to this, but I believe it was over the last 12 years. The S&P was up about 8% per year over the last 12 years, maybe a little less than that. And emerging markets was up just over 2% per year over that 12 years. And developed international was up just over 2%. So literally, domestic has outperformed by 6% per year, both of those areas over the last 12 years. Well, if we look at history to give us a guide on what will happen in the next 10 years, it's not likely that domestic is going to outperform international over the next 10 years. I mean, you can just look at this chart. It's outperformance by international, followed by outperformance by domestic. International, domestic. International by a lot, domestic. International, domestic, international, domestic. We believe international. I think we've probably hit this home pretty well. But just to give us another metric here, we want to look at the relative attractiveness from the all country world index, excluding the United States, versus the S&P 500. The current PE ratios of each, the all country world index is 78% of the S&P. It's normally 89%. So people are not paying what they normally would pay compared to what they are paying for domestic companies. And that's because there's blood on the street. And that's when no one wants to buy these companies because it's really hard to do so. But we believe if you have a long time horizon, you're going to get rewarded for doing what most people will not do, which is buy when people are not willing to pay as much. That's what if you want to be a successful investor, that's how you buy at a discount. You buy when other people don't want to buy. And then if we look at the dividend yield right now, and remember, what are two things that drive stock prices? Earnings and dividend. Right now, outside the United States, the all country world index, we're getting a dividend yield of 3.5% versus the S&P at 2. That's 172% more. We usually only get 150% more. So once again, that's telling us that X the US, we have more attractive buying opportunities. Central banks. Let's talk the Fed a little bit. So July 30th, two days ago, the market closed at 2.06%. Today it closed at 1.91%. So 15-point swing in 2 days. That's a large swing. And you can see that it's coming off of a already pretty substantial. This was 3.25 at the high here, and we're much lower than that now. We're at 1.91%. We've got real yields. This is as of a couple days ago, so real yields now are more negative. You can see that real yields being negative does not happen very often, and when it happens, it corrects very quickly. And so we believe that the market is a little offsides here. One, we believe that there's going to be a China deal. And when that happens, it's going to alleviate some of this recession, global recession risk. And we also believe that the market is way offsides on what the Fed is actually going to do. So yesterday, the Fed came out and said, we're going to cut a quarter of a point. And during Federal Chair Powell's testimony, in the middle of his testimony, he said, we see this more as a mid-cycle adjustment. And he even said he referred to other periods of time where they've done these mid-cycle adjustments. There have been two recent, what I would refer to as mid-cycle adjustments. In 1995, the Fed was raising rates. And they actually changed from raising rates to cutting rates. They cut 3 times in a very short period of time before they then started raising rates again. And then again in 1998, they also did 3 cuts before they started hiking again. So there is precedent set for what we'll deem as what Fed Jay Powell meant by saying mid-cycle adjustments. That definitely did not make the market happy yesterday. The market was looking for maybe a more prolonged, maybe 4 or 5 rate cuts. And you can see that here in the expectations. These are the market's expectations. So in the end of 2021, the market expects the Fed funds rate to be at 1.34%. That's basically 4 cuts, including yesterday. So 3 more cuts. Whereas the FOMC year-end minutes, now granted, they're probably changed by now, but they see a much different picture. They did. They're probably somewhere now in the middle of these 2 lines. But you also had 2 voting members that dissented yesterday and didn't want to cut rates, wanted to keep them the same. So you don't have as dovish of a Fed as I think the market is hoping for. And that's why we believe that rates are pretty low right now compared to where we think they should be long run. Starting yield, this just tells you, if your starting yield, if you buy a 10-year treasury at 1.9%, you pretty much should expect to earn about 1.9% over that 10-year period. So 1.9% is not going to give you, basically with inflation right around 1.6, and a Fed target of 2, probably going to give you a 0 return or close to a 0 return after inflation. So when you're buying bonds right now, you're not buying them for income. They're just not producing enough income. 1.9% for a 10-year treasury, it doesn't make a lot of sense. If you go outside the United States, it even makes less sense. We're talking negative yields. However, bonds still do make sense for a portfolio of assets because they're one of the only asset classes that moves inverse, the opposite direction of stocks. So we definitely don't want to just abandon them, but we also want to know that we're not expecting a lot from them. If we're looking at a bond portfolio right now, you're probably looking at somewhere around 2.5%. Going forward. Not exciting. Definitely not exciting. And everyone who's got the online savings accounts that are paying close to 2%, with what the Fed's done, with what the market's done, expect those rates, if they haven't already, expect those rates to come down in line with where current rates are. Cash is not a good long-term option. It's barely going to keep up with inflation. And in previous years, it didn't even keep up with inflation. So we want to make sure that, we want to have cash for the short run, the 1, the 2, the 3-year period where you're going to need money for an expense, a living expense, a car, a fix a roof, an AC unit, whatever it may be. If it's coming up in the next 3 years, probably shouldn't really be tied to stocks or bonds or any alternative investments. Probably should be held in cash, earning 1 to 1.5% when all the dust settles. That's probably what these money markets are going to continue to pay going forward until we have some adjustment in the Fed funds rate. If we look at stocks relative to bonds, once again, we talked about this. Stocks are still relatively attractive compared to bonds. The earnings yield, which is just the PE multiple flipped over, is 6%. So if we looked at the S&P as a bond, we'd be earning 6% in earnings on our principal versus 4.3% from a bond. That doesn't necessarily mean that the S&P 500 is super attractive. It's attractive compared to these bonds, but if these bonds are way overpriced, then maybe the S&P 500 is a better place to put your money, all else being equal. But like I've said before, and I think you guys get the picture by now because we brought it up several times during the last hour, outside the United States is much more attractive. And we have a decent amount of our portfolio that's been moved into those areas to try and take advantage of that, of the prices that we see. Earnings, we're coming up on 5 o'clock, and I want to make sure we have enough time for questions. I'm going to skip that. This is also, telling us we want to just make sure we don't get into a home bias, home base bias. We want to make sure that we do have exposure outside the United States. Commodities have done horrible the last 4 or 5 years. They're once again at decent prices. We've got the Bloomberg Commodity Index, a little over 1 standard deviation away from where it normally is. And you can see the range here. So commodities, we believe if global growth picks up, a lot of these commodities also go back to more normal levels. And once again, they're an asset class that doesn't act necessarily like bonds or like stocks any given day. Bonds, we don't want to abandon bonds because they do help with our volatility. If we look over the last 20 years, we can see that although the ending values are the S&P 500 has a $25,000 higher ending value over a 20-year period, the way you got there could have been very nerve-wracking if you have 100,000 in 1998, and in September 2002 you have less than 70,000. Whereas if you would have just had a 60-40 portfolio, your worst time or during that same period of time where you're down 30% in your S&P portfolio, you're only down 9% in your diversified portfolio. And then even in the crux of the financial crisis, once again, you went back to 70,000 in the S&P 500. You're probably like, wow, I've been investing for 10 years and I'm down 30% over that 10-year period, 29%. That's not good. You probably would have been making some changes during that period of time. If we were to look at an emerging markets portfolio over this period of time and added that emerging markets during that 10-year period, emerging markets over that 10-year period was up about 100 and some percent over the same period of time where the S&P 500 would have lost you 29%. So there are different 10-year periods, and each asset class gives us a different outcome depending on the next 10-year period. What people really need to avoid is to chase the returns. When you chase the returns, that's when you end up harming yourself. But this chart is just trying to get the point across that having bonds, although they're not paying us very much, they're still a good diversifier, and their principal can go, bond rates could go down even further. Who knows? And if stocks go down and we have a recession, the 10-year treasury might go to 1%. And if that happens, bonds are going to be positive over that period of time. And we can use our bonds, sell our bonds that now have gone up a little bit. And that gives us a buying opportunity to buy some stocks that, if that happens, probably don't do very well. So they act as a hedge. I'm going to skip this one. I'm going to skip this one. I'll go into this a little bit. We're overweight domestic small cap. Oops. We're overweight international, developed, and emerging markets, and we're overweight emerging market debt. We're underweight long duration fixed income. Almost all of our fixed income is short duration, with the exception of our emerging market debt. We are a little light on large cap domestic, but we still have a large chunk in the portfolio. We're just lighter than we normally would be. We prefer international. And we have completely eliminated, unless you had a tax ramification, we've completely eliminated REITs and utilities from the portfolio. So with that, I will open it up to questions. Nick, you want to go ahead and get the questions started?
Sure. Thank you, Steve. Hey, I think it was a slide number 3 in the top right-hand side. It was definitely close to the beginning of the webinar. You talked about things that drive valuations, and you emphasized that earnings and dividends were arguably 2 of the most important factors.
Yep.
You had also put in there how multiples were a factor of driving valuations. Yes, the gray boxes.
Yep.
And it kind of went over my head a little bit. I just wanted you to just explain a little bit more about, define what you mean by the multiples component for me.
So this is looking at the change in multiple. So over the short run, if we have a change in multiples, so in 2018, our multiple on the S&P 500 at the end of January in 2018 was almost 19 on the S&P 500. Okay. And then by the end of 2018, our multiple was more like 15 and a half. So you went from 19 to 15 and a half. So the change in multiple is what I'm talking about with these gray bars.
Got it.
And then in 2019, we had exactly opposite of that. We flipped, and now our change in multiple went the opposite way. Well, over the long run, multiples stay about the same. And that's the whole point. People will pay about the same for a cash flow of earnings. It's not to say if, and that normally is in a normal environment, somewhere around 15 to 16, call it 15 and a half. And so if in a normal environment, the S&P 500 is trading at 10 times multiple, well, there's a really good chance that 10 times multiple goes up to 15 times multiple. And what we see in that type of an arrangement is at some point, it might not happen over a year's period of time, but over the long run, you have an improvement in multiples back to their normal levels and an outsourced return because your multiple improved. Does that help?
Yeah. Yes. Thank you. Well, we don't have any questions from the rest of the attendees, so I guess if you want to make some concluding remarks and wish everyone well.
My concluding remarks are that, and you know, our clients are really good at this. I think we do a good job of setting expectations correct. We're in these equity type investments for the long run. The markets were at all-time highs. Your portfolios were a stone's throw away from all-time highs a couple days ago. Small cap, emerging markets, international has been a drag on the portfolio, but domestic, large cap, REITs, utilities have helped pull the returns up. And over the long run, we want to make sure that we stay diversified, and your portfolios are diversified. And we believe in looking at 10-year periods, 20-year periods, and trying to take advantage of the noise that happens over the short run. Things like today, in my opinion, are noise. You're going to see a blip when we look at these long-term returns. It's a blip on the radar. I mean, you can hardly even tell some of these things that happened. Black Monday. Yeah, I mean, it still looks pretty big in this chart, but in the grand scheme of things, had you invested here and in about a couple of years, you're still back positive. In 10 years, you're doubled your money. So all of these things, we need to make sure that we have the correct time frame, and then also we just need to make sure that we have the fortitude to put some money to work in areas that probably you're going to feel a little more uncomfortable with, but longer run, we believe you'll get rewarded for that. So with that, thank you everybody for joining our call tonight again, and we will do this again in November, early November, first Thursday of November. Good night, and talk to everybody soon. Bye.